Good morning. Time now a few minutes after 8 o'clock in the morning in Tokyo, Friday, April 28th, 2022. Welcome to another edition of the online seminar organized by the World Bank Tokyo office. My name is Koichi Omori. I am Senior External Affairs Officer of the World Bank based in Tokyo. We organized an online morning seminar to introduce the latest report with the World Bank economists and specialists. Twice a year in April and October, the World Bank Prospect Group publishes Commodity Market Outlook, which is monitoring the price data of about 46 commodities and compiling price forecasts along with the historical data. The April 22 edition was just released on April 26 this week. With us connecting from Washington, we have John Buffett, Senior Economist in the Prospect Group. John is the longtime leader of the World Bank's commodity market programs and the regular speaker in our morning seminar programs to introduce the latest edition of the Commodity Market Outlook every time issued out of Washington, D.C. Good morning, good evening to you, John. How are you?
Thank you, Koichi. Good morning, everybody, or good evening if the time zone is different. Thank you very much for organizing yet another interesting and important seminar on the commodity markets outlook. Thanks to you and thanks to your colleagues in the Tokyo office. In fact, this is the first kind of formal, so to speak, presentation that we make on the commodity market outlook. So I'm honored in a sense to make that presentation to the Tokyo office. And before I begin the presentation, let me also say a big thanks to my colleagues here in Washington, the team for the Commodities Outlook, who have worked really tirelessly day and night, especially the last couple of weeks, to put this document together, especially with the events that unfolded in February, the war in Ukraine that really changed completely, so to speak, the outlook of the commodity markets. So,
all right, great, John. Before getting into the content of the presentation, let me make one more housekeeping announcement, which is about a question from the audience. Thank you for sending the question in advance. If you did not have an opportunity to send your question in advance, even during the seminar, please send your questions using the online format posted on the announcement page in our website, or simply post your questions on the chat section of the YouTube screen. I'll read your questions, after John's presentation, asking him to respond. So with that, I would like to ask John to come in to start his presentation formally for next 30-40 minutes to share the main findings of the latest edition of the Commodity Market Outlook. John, over to you formally.
Thank you. Thanks, Koichi. Again, let me say a big thanks to my colleagues here in Washington. Let me begin my presentation and just to give you a sense of what I'm going to talk about today. Basically, I'm going to first summarize the recent price trends in commodity prices. And then I'm going to look at developments in the three main commodity markets that we analyzed, and that is energy, metals, agriculture. In the context of the developments in the agricultural sector, I'm going to also touch upon development issues, trade and price issues that have unfolded in the fertilizer market, very important input for agricultural production. And lastly, I'm going to conclude with a price forecast, give you lots of numbers, and also discuss the risks to the outlook and what we expect looking forward in the medium term. So just a summary of the report, a few bullet points. Of course, with the war in Ukraine has caused a major supply disruptions in commodity markets, and it has led to historically high commodity prices. Certainly, most commodity prices have reached high levels in nominal terms, and a few have reached record high levels in real terms. Now, the war also, I should add, that has added to the broad-based rise in commodity prices that began in the mid of 2020 after the COVID-19 pandemic. We expect most commodity prices to be significantly higher in 2022 than 2021, and we also expect most of them to remain high for the medium term, that is 2023 and 2024. In terms of specific commodities, the crude oil average, the crude oil price we expect it to average around $100 per barrel for this year, that is 2022, which is more than 40% higher than its average last year. In terms of non-energy commodities, we expect them to be about, on average, 20% higher this year compared to last year. And as expected, of course, the largest increase are likely to take place in commodities where both Russia and Ukraine play a major role and they are key exporters. Specifically on wheat, which is a market that has is very concerning and very important in terms of food security implications. We expect wheat prices to be about 40% higher this year compared to last year. And as I said earlier, we expect generally prices after 22 to remain much higher than what we expect them would be a year ago, or even in our earlier commodity outlook in the October 2021 edition. Lastly, the last point I would like to highlight is that the outlook depends, of course, very, very much on the duration of the war in Ukraine, how severe the disruptions are going to be in commodity flows. In fact, there are risks that some commodity prices could go even higher than what they are, especially energy commodities. There are a number of other risks that I will focus on them later. Let me now begin with a broad picture of how commodity prices have evolved recently. We see here the three main indices that we monitor: energy, agriculture, and metals. Energy is pretty much dominated by the price of crude oil. Agriculture is a very broad index that includes both food commodities such as maize, wheat, soybeans, and rice, but it also includes some raw materials such as cotton and natural rubber, as well as some what we call beverage commodities, including, let's say, coffee, cocoa, and tea. And then the metal price index is the usual, what we call them the base metals, such as aluminum, zinc, and nickel, and copper, as well as iron ore. So it's a composite index of 7 metals. As you can see, we had a sharp decline right after the pandemic, and then prices of all commodities, or rather all commodities, commodity indices began a recovery. And we see towards in the first quarter, rather, of 2022, that all of them spiked, mostly due to the war in Ukraine. And by now, or at least at an index level, those three indices are at nominal levels which are much higher than the levels that we had experienced back in the 2007 and 8 commodity price spikes, or even the 1910 and 11 commodity price spikes, which you can clearly see here in the chart. Let me, before I continue to the specific commodities, discuss the developers in specific commodity markets, I just wanted to give you a glimpse of why, or rather in which commodities Ukraine and Russia are important in commodity markets. As you can see here, those countries are important in all major commodity markets. For example, Russia accounts for almost more than 25% of natural gas exports and about 15% of crude oil exports, and almost 20% of coal exports. So energy is a very important sector that depends a lot on Russia. Then when it comes to metals and minerals, Russia also accounts for quite a bit of pig iron, palladium, platinum, and aluminum. And by the way, on fertilizers, both Russia but also Belarus are important fertilizer exporters. And when it comes to food markets, we clearly see the role of both Russia and Ukraine, especially in the market of wheat. and barley, and to some extent corn, and a little bit of edible oils that, again, those two countries play a very important role. And that's the reason why we've seen not only the price increase in the last quarter, but also the huge price volatility, large price volatility, at least those commodities. Let me now turn to the commodity groups, or rather the energy market group. I'm going to give you an idea, a glimpse of how prices evolved the past few months compared to by looking at the entire decade. We see that crude oil prices have averaged around $100 plus in April. But what we see here is that the important point is that crude oil prices have now reached the levels that we had experienced back in the high price period during 2010 and 2014, before prices collapsed. So prices now are pretty much at the same level as we had experienced a decade ago. Now, when we look at coal and natural gas, and that is natural gas in Europe, the picture there is entirely different, or much more severe, I would say. There we have seen prices that are 3, 4, or even 5 times as high as they used to be back in 2010 and 2011. And in fact, looking at the energy sort of complex, the energy group of commodities, it is coal and natural gas that I would say are the ones that cause, if I can call that, the problem in the commodity markets, much more so than the oil market. Now, in this chart, I'm showing you monthly prices since 2010, but I think it's very important to put the recent price increase in a much longer time perspective. And here I'm showing prices of oil since 1970, and those, by the way, are in real terms. We have adjusted them to be real in January of 2019. And what we see here is interesting in the sense that in real terms, prices are indeed high now. As I said, they are averaging lately around $100 and $110 per barrel. But if we look historically, again, in real terms, that we look back both in the late 1970s as well in the spike of 2007 and 2008, what we see is that real prices back then were much higher. For example, prices today are about 30% lower compared to the high they had reached during the third quarter of 2008. Now, this is about oil. However, when we look at, let's say, European natural gas prices, and we take the same time interval, 1970 to now, 52 years worth of data, we see that the picture is entirely different. We see something that happens in the European gas prices that has never happened before. Today, prices are trading around $40 per British thermal unit. And on average throughout this period, again, in real terms, they have been traded for average for $8. So we're talking about a 5-fold increase from $8 to $40. And that's the European natural gas prices. When we look at coal, we see a similar picture. Prices of coal now fluctuate around $303 plus dollars per ton. We had seen $200 ton of coal back in the spikes of the price increase of 2008. But when we look at the average over the 52-year period, coal has averaged a little more than $80 per barrel. Again, we are looking at an average of $80 per barrel over the 52-year periods versus $3, per barrel, per ton, apologies, per ton versus 30, almost $300 per ton now. Again, what we see here is an almost 4-fold increase. So just to summarize in terms of the longer term perspective of the energy markets, we certainly have seen an increase in all three markets, main energy markets, but when we look at individual commodities, oil is not the big sort of change. It is natural gas in Europe of course, natural gas in energy form, liquefied natural gas, and coal. And that's one kind of takeaway point I would like to get across from the energy markets. Now, what happened in the oil market? Of course, we had a huge, much stronger than expected demand on oil after the decline we saw in the first quarter or in the first half of 2020. Demand recovered in a very unexpected way on oil. And supply, in fact, did not follow through, did not follow the demand increase. And in the chart to the left, what we have done, we look at the progression of supply change compared to a base of January 2020, which is pretty much the month prior to the pandemic as our base case. And it's interesting that what we see is that, yes, the supply of oil, globally speaking, does increase, but today, for example, the latest data that we have, which is March of 2022, we do see that supply of oil is short of around 2 million barrels lower than what it was back in January of 2020. Now, oil supply and demand grows on average around 1% per year. So the 2% or 2% gap that we see now, if we add also the natural rate of growth, it's about 4% gap, I would say, compared to 2020. So that's one observation, that supply has not followed the demand sort of growth. The second observation is that what we see when we look at the detail, the kind of decomposition of this growth, what we see is that OPEC, in fact, has returned to the production level that they had back in January of 2020. What the gap comes from the rest of the world. Now, OPEC, the major producer is Saudi Arabia. Then we also see that OPEC plus countries, excluding the main OPEC countries, also have kind of recovered. That's the yellow part. There is some gap there, but not as much. The big problem, so to speak, or the supply gap that we see today comes from the inability of non-OPEC plus countries or the rest of the world, as we have named it here, to follow the demand, the strong increase in demand. So that's the main sort of one of the reasons why we've seen this upward push in the price of oil. And of course, what happened in the past 2 months in the war with Ukraine and the disruptions by the Russian oil supply and the uncertainties about what's going to happen with imports from Russia and if there is a full embargo or not, have added a lot. We have fueled the price volatility and uncertainty. Now, to the right, I'm also showing you US oil production. And in fact, we clearly see there that we have not reached yet the levels of oil production that the United States achieved back prior to the pandemic. There are a number of reasons for this. One reason is that a lot of the oil production, shale oil production in the United States that used to be independently operated by smaller companies now has changed ownership. It is owned by what we call the so-called major oil companies. And those companies are more reluctant to engage in large investments because they are interested more in delivering returns to shareholders rather than expanding production. So that's one of the reasons that, the main reason I would say, that we have not seen shale production increase as much. And we also have the other side, the investment side of banks, because a lot of banks lost quite a bit of money after the collapse of oil in 2014. They are also not as eager, or they're reluctant to engage in lending, in plentiful lending, as they had done prior to 2014. So the combination of the reluctance of, or rather the focus of companies to generate returns that are expand production, plus the reluctance of banks to engage in lending, has caused, so to speak, production growth, I would say, or production in the United States not to reach the levels that we had seen earlier. Let me now turn to metals to have a brief look at what happens in what happened in the metals market. And as we can see to the left, again, consistent with most commodity prices, we saw a decline in metal prices shortly after the pandemic, which was a mirror image of what happened in the global industrial production, and especially industrial production by China. The so-called PMI index, the Purchasing Manager Index, Power Purchasing Manager Index, which pretty much tracks very, very well the industrial production. It's a very nice proxy of industrial production. So prices recovered. We did see a kind of stabilization or even a decline in the PMI index. Despite that decline, we do see prices of metals going up. And the increase in price of metals reflects, for the most part, some disruptions in trade. And we saw problems that arose in the nickel market, where, as I said earlier, Russia is an important exporter. So that's probably one of the reasons why we have seen the increase in metal prices. We also saw a lot of increases in a lot of rather disruptions in the global metal market. And in the case of nickel, some countries engaged in some trade restrictions. That's what kind of generated the spike in metal prices. Of course, when we separate the base metal price index, which, as I said earlier, consists of the base metals, including aluminum, zinc, nickel, etc., versus the iron ore, the price behavior is a bit different. We had the iron ore collapse in prices, which began in early 2021 and lasted almost a year. That's because of a collapse of steel production, mostly in China, because most of iron ore goes for steel production. And if there's a collapse in steel production, then you have a collapse or a decline in iron ore prices. But what we see now that, especially after the war in Ukraine, the path of iron ore prices has pretty much mirrored the path of the remaining metal prices. Now, just to elaborate a bit more on the metal market, in the chart to the left, we see how global consumption of metals has evolved throughout the past 25 years, and it clearly shows there that the dominance of China in global metal price consumption. They started from a bit less than 5% back in 1995, and today the country accounts for more than 55% of global metal consumption. So that's one observation. And the second observation is that we see that in global terms, we also had a huge demand increase for metals. That was one other reason as to why we see the sharp increase in metal prices. And we saw a full recovery pretty much for the rest of the world, and much more recovery in China. And that's clearly shown to the chart of the right, where we look at monthly changes in metal consumption on a year-to-year basis. It's very important to note that. And we see that during the pandemic period, in fact, China did not reduce its metal consumption. It kept growing at pretty much historical levels. It was OECD and other or non-OECD countries that reduced metal consumption, but at the beginning of 2021, pretty much metal consumption recovered across the board, as we also see in the chart to the left. Now, let me move to agricultural markets and get a glimpse of what happens in agricultural prices. Again, consistent with the previous slides, I'm showing the monthly prices for the three main agricultural price indices, beginning in January of 2011. We decompose agricultural price into three indices. Food, which, as I said earlier, includes all food commodities, that is grains and mainly grains and oilseeds, such as soybean oil, palm oil, and grains, which is wheat, maize, etc. The beverages, which is coffee, tea, and cocoa, and the raw materials, which pretty much is dominated by cotton and the timber and the natural rubber. What is interesting about the behavior of these three commodity indices is that while they were quite stable for the 5-6 year period between 2015 and early 2020, or I would say 2021, then we kind of saw a recovery in prices, but then we saw a huge divergence. On the raw material side, they kind of picked up a little and they returned to a broadly stable path. Then we have an increase in beverage index, which pretty much reflects, or not pretty much, which reflects only the increase in coffee price, which took place late last year, or even before that, the entire last year, because of a weather problems, frost in Brazil that decimated the Brazilian coffee crop. So that's what the beverage, price index reflects, or the spike of the beverage price index reflects. But we have a completely different story for food prices. We see that food prices pretty much went up by a factor of about 80% between the lows of the second quarter of 2020, in the early stage of the pandemic, until recently. There are a number of factors that are behind the increases of food prices. Of course, the war in Ukraine is one. That's why we observed a spike during the past 2 to 3 months. But before I elaborate on the reasons, let me also show you the food prices, but in fact, I'm taking wheat prices here from a longer term perspective, as I did in energy markets. And what we see in food markets, or rather in wheat market in this chart, is that we do see a spike taking place for the past, as I said, the past couple of years. But when we look at longer term perspective, in real terms, we see that we are not yet up to the levels that were in 2007 and 2008, in this spike 15 years ago. We're a little lower than that, but we're way lower than the highs we had experienced, the wheat market had experienced back in the 1970s. So today prices are about 1/3 in real terms, again, that the spikes of the early 1970s, and pretty much the same picture is valid for, I would say, across most food commodity prices. So again, as I said, they have spiked quite a bit. We are about close to 2007 or 2008 levels, but no way close to early 1970s. Now let me return to the shorter term, developments. And what we see here is a production growth for two commodities, wheat and soybeans, which are two of the four more important commodities, which include also maize and rice. And we do see here a shortfall in production in the ongoing season, which ends in summer of this year. And we see a shortfall both in wheat and soybeans, and that's because of a shortfall especially in South America, due to adverse weather conditions earlier last year and later intensified by the La Nina effect. So we see this shortfall in those two commodities, and that's one of the reasons that we saw the spike in commodity prices. Now, again, trying to look at it over the same time period, what we see is that food prices, I wouldn't say that they're food commodity markets, I wouldn't say that they're well supplied, globally speaking, not in individual countries. I will elaborate on this later. When we look at the stock-to-use ratio, which is a measure used in commodity markets, in the food commodity markets, grains and oilseeds, which measures how healthy, so to speak, is the availability of the crop, we see that on average, well, it has been quite some volatility in that ratio when we look at individual commodities, and there has been a decline for all three, wheat, rice, and maize. When we look at a global level at the food aggregate for the stock-to-use ratio in the chart to the right, we see that yes, we did experience a decline from 31% in 2007 to 28% in the last year, or rather in this year, in the ongoing season. But the 28% or 0.28 is much higher than the lows we had experienced back in the spikes of 2007, 2008. Back then, this ratio was down to 0.17. And we saw how sharply it came down from the highs, the historical highs that it was in 2000, back in 2000. So, in short, the short summary from this picture, from this slide, is that there are pressures in food markets, but in terms of supplies, again, let me elaborate global supplies because there are issues, of course, in various countries. In terms of global supplies, we are not yet in the lows that we had experienced back in 2007 and 2008. So what are the risks or the other causes for high food prices? Apart from the shortfalls that I mentioned earlier, one main reason is that input prices have decreased, as you can see to the chart to the left. Input prices have increased a lot. As I said earlier, natural gas prices, especially in Europe and LNG, have skyrocketed. We have coal prices which skyrocketed. That has caused fertilizer prices to go up. Some fertilizers use natural gas as input, especially the ammonia-based fertilizers. In China, ammonia-based fertilizers are produced mostly from coal. So increase in natural gas prices and coal prices have been a key reason behind the increases in fertilizer prices. But we also have other issues, policy issues. For example, we had Belarus last year, to which Belarus, as I said earlier, is a major exporter of potash fertilizers, and there was a ban, some sanctions from the European Union and the United States. And then we have other types of fertilizers that also depend to different degrees on energy prices. So energy prices, the bottom line is that have caused fertilizers to go up, and in turn fertilizers prices have put upward pressure on the cost side on food markets, on food commodity prices. And to the right, we see biofuel production. We had a decline as expected in 2020 because of the pandemic and not much, it was less used for fuel for transportation. But then in 2021, we pretty much the demand for biofuels or the production of biofuels recovered to pre-COVID levels. And although I'm not showing you the data for 2022 here, indications are that 2022 may be just as high or perhaps even higher than the biofuel production we experienced in 2021. Now, in terms of biofuels, this is a very important component of food production and a very important risk down the road, because although biofuels account for, as we can see here in the chart, about 1.8% of liquid energy consumption. By liquid energy consumption, I mean pretty much crude oil. When we look at the global energy consumption, we include all other kinds of energies, all other types of energies, such as coal and natural gas and renewables. Biofuels account something between 0.5 and 0.6% of global energy consumption. Now, when we look at the production side, or rather the diversion of food commodities of biofuels account from perhaps between 3 and 4% of global land allocated to food. So, and here we see interesting math that 0.5% of biofuels account for energy, but about 3 to 4% account on the land side. So you can see why biofuels can put an upward pressure on food prices. And not as much benefit, so to speak, if I can put it this way, on the energy market. Now, the issue with biofuels and the risk rather as we go forward is with the high energy prices. Policymakers, of course, are inclined to increase the availability of liquid energy production that is, or consumption that is crude oil. And we may see even more diversion of biofuels, or rather we have the risk of seeing more diversion of biofuels down the road, which is going to increase, put upward pressure on food prices. And in fact, we have seen that in the United States, which changed the regulation for the summer season from the so-called E10 to E15 consumption. So now the blend in the United States for transportation fuel will be up to 15% coming from biofuels. Now, that does not make a material difference at a global scale, but the way we interpret that is a trend that may be followed by other countries and therefore put more upward pressure on food commodities. Lastly, I would like to share some numbers with you. We have both historical numbers and commodity price forecast here. I'm just showing you the indices. We have all available, all numbers in detail available for all commodities in the publication, the Commodity Markets Outlook. You can see the shaded area in the middle, percent change from previous year for 2022 forecast. And I would like to highlight basically three numbers there. One is that for fertilizers, we expect 2022 to be prices to be 70% higher than 2021. Basically, I mean, giving us a glimpse of the pressures that's going to be we're going to have on food prices. Then we see the energy price index to increase by more than 50% in 2022. And then the remaining of the indices, the non-energy indices, are expected to increase by about 15 to 30%, on average about 20% for this year. We do expect some moderation, some easing, so to speak, in most prices, not all, most prices indices next year, but by no means we are not going to return to the low, so to speak, prices that we experienced between the 5-year period 2015 to 2020. Now, what are the risks to this forecast? Many risks. I can take a long time to outline, I mean, to talk in detail on those risks, but most of the risks are in one way or another related to the war in Ukraine, basically how long the war is going to last and what is going to be the reaction for countries, other countries, in terms of further sanctions, especially in energy markets. But again, if we have more disruptions in energy markets, we're going to see more increased fertilizer markets, we're going to see more upward pressure for food prices. So, in fact, we have seen this kind of chain of events unfolding very precisely throughout the past 2 years. Another risk on the demand side, especially on the industrial commodities, originates from China. There are two issues with China. As I said earlier, China plays a huge role in metal prices, in metal markets, and a somewhat important role in energy markets, especially coal. And in China, there are two risks. One risk is the property market. Depending on how it unfolds, it may have a negative effect on demand. But we also have the lockdowns in China. What we have seen in Shanghai, if that spreads to other countries in China, to other cities in China, or if the lockdown is prolonged, that might have an effect both on the demand side of commodities, but we also have an effect on how supply chains unfold. So we may have issues both on the demand as well as the supply chain. So it doesn't mean that China, for example, what I'm trying to say is that can play both a role of having upward pressure of commodity prices as well as downward pressure, depending on whether the effect applies to the demand side or the supply chain disruption side. Lastly, I would like to conclude the presentation with what are the risks emanating, starting from commodity markets to the countries. And I'm showing you two charts of domestic food price inflation. To the left, we see for the regional averages, East Asia, Central Eastern Europe, Central Asia, Latin America, Middle East, North Africa, South Asia, and Sub-Saharan Africa, in that order in the chart to the left. And we see that indeed inflation on average in all regions has picked up, and especially in both LAC region, Latin America and the Caribbean, as well as Sub-Saharan Africa, have reached inflation far above 10% on a year-to-year basis. This is an average for the past 3 months, rather December, January, February of this year versus the 1 year ago. Now, a number of countries face huge price inflation issues. You can see in the chart to the right, in fact, which mirrors in a sense in the chart to the left. We see, for example, Zimbabwe or Iran having high inflation numbers, and that pushes the Africa region, Zimbabwe, and the Middle East and North Africa region in the case of Iran. We see Turkey and Argentina, important countries from the emerging market developing economic group, which have inflation running in the case of Turkey at 70%, in the case of Argentina at 60%. So it's not that we see inflation in small countries, low-income economies, but we see inflation even in bigger countries. And that's, I think, the most important risk that countries face right now. And of course, when you have high food price inflation, you also have food insecurity problems, especially in low-income countries, which, according to some early estimates, we see that food insecurity has increased quite a bit. It's expected to increase quite a lot this year. At this point, I would like to conclude my presentation and just let you know that the presentation, of course, you can see it on the website from our colleagues in the Tokyo office, but I will also post it on my LinkedIn account. All the numbers I have quoted here and all the statements that I have made can be found in the Commodity Markets Outlook, which was published yesterday, April 26. We plan to publish a series of blogs on individual commodity markets or group of commodity markets, which are going to come out in the weeks ahead. We just published a blog today, and we plan to publish a couple of blogs next week. And lastly, I would like to mention that in our report, we have a long 20-page section which focuses precisely on the effects of the war on Ukraine on commodity markets, but we also look at it both from the short-run perspective as well as long-run perspective, and we have made an attempt to find what kind of similarities the recent cycling commodity price has with earlier similar developments. And what we found is that the recent developments mirror those of the 1970s, and to some extent, the cycle of 2010 and 2011. And one point that I would like to emphasize that came out very clearly from this analysis is that we've seen this interesting and very interesting and similar pattern across those three booms in commodity prices. We've seen first energy prices go up, then fertilizer prices go up, and then food prices go up. And then that triggers, of course, a number of policy responses, which in conjunction with higher prices trigger a number of numerous market responses. Unfortunately, I don't have time to go through all the details, but you are welcome to look at, of course, you can look at this. It's worth reading the section, and I'll be glad and happy to answer any questions through email or any other means that I can be reached. Again, thank you very much for attending the seminar, and again, thanks to Koichi for giving us the honor to make the first full presentation on the CMO, Commodity Markets Outlook.
Thank you very much, John, for your sharing the main findings of the very recently issued Commodity Market Outlook, which was just released earlier this week in a very challenging situation in a global terms. We received several questions from our audience, including some questions just came in. So let me read those questions, asking John to respond. First question, would you please comment on the impact of the current commodity market on the shift to cleaner energy and green economy? John, please.
Thanks, Koichi. Well, that's a very interesting question and important, rather. Let me say the following, that separate basically the impact, the short-term impact and the long-term impact. And I think that's the best way to look at it. In the short term, indeed, it may have a negative effect because what we see now is that we have a lot of shortages in natural gas. We may face shortages in crude oil. So inevitably, we'll see, of course, a reduction in consumption across energy, but we may see an increase in the consumption of coal, which, as we all know, is the most sort of polluting, shall we say, of the three fossil fuels. So in the short term, we may see a pullback or a deceleration, if I can call it this way, of the energy transition. So to summarize, the news may not be as good in the short term. Now, in the long term, probably we're going to see an acceleration in the energy transition. I think governments and politicians now have realized that not only fossil fuels are associated with environmental issues and climate change, but we also we also realized that fossil fuels is a risk in terms of supply, availability, and trade. And one way to minimize that risk is to rely less on fossil fuels and to engage in energy-saving technologies, as well as increase of energy-friendlier, so to speak, sources of energy, including, of course, solar panels, wind energy, and other kinds of energy types, as well as storage of electricity, which is very important for the transition, including the trend to increase transportation based on electric vehicles. So, in a nutshell, perhaps not very good news in the short term, but our view is that in the longer term, the current environment may benefit the energy transition.
Thank you. Thank you for your responses. That was a question from Sasaki-san. Thank you for your question. Next question from the anonymous participant. Thank you for your question. What would be the report's key messages to the leaders, particularly of the developing countries, who may be additionally challenged, caused by higher prices of the commodities, while already facing with the difficulties in physical space?
Thanks, Koichi, and thanks the viewer and for asking this question. Now, let me say this is a much tougher question than the previous one. Very tough, because as I said earlier, a lot of small countries are facing high inflation, high food price inflation, and as we have seen from other agencies like the FAO in Rome and IFPRI here in Washington, that we see an acceleration in the number of food insecure people around the world, and now we have added food insecurity even from Ukraine, in addition to the other hotspots that we had earlier. Now, in terms of what policymakers can do is, when you have limited fiscal space, that's a big constraint, but at least policymakers should not engage in policies that adversely affect food markets. And although we understand that, by we meaning both analysts as well as the international institutions, we do understand that sometimes policymakers, they have to resort on sort of measures such as giving subsidies, and probably they should in the short term. In the long term, they should make sure that the way they intervene in the food markets or in the energy markets for that matter, they do not have a distortionary impact. Now, on the fiscal space that you mentioned, of course, this is a huge constraint that with the pandemic, a lot of countries have to deplete, so to speak, the fiscal space that whatever fiscal space they had up to 2020. But on that point, let me also say that coming from an international institution, our leaders, both the IMF, the World Bank, as well as leaders of the IMF and other international organizations, have assured us that there is plenty of scope that countries can resort from our help, from our organizations, to address issues of food insecurity and food price inflation. So I think now the international community is not only willing, but able also to engage in lending operations and as well as in other kinds of operations to sort of ease, so to speak, the impact of food price inflation and food insecurity. But again, as I said earlier, Koichi, this is a very tough question because we're in an environment where you have food price inflation, food insecurity, limited fiscal space, in some cases high debt, and the big elephant in the room is interest rates. What's going to happen to interest rates? I mean, we have signals across the major central banks that interest rates are going to go up, which means the cost of lending is going to go up. And to add to those news, sort of bad news, if I may, the food prices are up for consumers, but we should not forget the fact that food prices are also, high food prices are also must be paid by the agencies like the World Food Program in order to deliver food supplies to countries. So that's we have very big problems and issues to address as international community. But as I said earlier, the international institutions, including our leaders, have assured that they will do the best to help poor countries.
Thank you. Thank you for your responses. We received a question from Professor Yoshino of Keio University during John's presentation. Let me read his question and comment. Actually, 2 points. First, would commodity price increase be a long-term trend, or would it be a temporary phenomena? If it would be a long-term trend, then structural policies should be needed for both suppliers and demand side. That's the first part. And the second point, in face with higher commodity prices, what kind of policies should country adopt? Is there any any good policy for importers? So these are the 2 points from Professor Yoshino. I'd like to ask John.
Very good questions and very deep and require quite a bit of thought. We have looked at those questions, in fact, in some of our research, part of our research agenda. And let me say, in terms of long-term prices, long-term trends of commodity prices, and again, that goes back to the long-term charts I showed earlier. What we have observed with quite a bit of statistical and econometric analysis is that when we look at long-term trends of commodity prices, we basically have 2 trends, so to speak. One applies to industrial commodity prices, metals and mostly energy, and the other trend applies to agricultural commodity price. Now, on the industrial commodity prices, if you look at the long-term trends, you see an upward trend. So if you remove the date, month-to-month volatility, so to speak, or the cyclical component, what you are left over is an upward trend. And that's for industrial commodities, which applies to both metals and energy. Now, when we look at agricultural commodities, the trend is entirely different. There is, again, excluding fluctuations and cyclicality, we have a downward trend. Now, which means what? We could see permanently higher prices on industrial commodities, especially energy, but that will depend a lot on the energy transition, not only on the energy transition itself, but what kind of policies are going to be adopted by countries for the energy transition. If we see that the policies are on the demand side, they limit the demand, prices may decline. But if we see that policies apply on the supply side of, let's say, energy commodities, prices are going to go up. So, in other words, we have seen historically upward trend in energy prices and metal prices, but the path will depend on the policies, the particular policies on the energy transition. On agricultural prices, I don't think we're going to see, and again, both energy and agricultural prices, certainly we're going to see, not certainly, most likely we're going to see elevated prices for the next 3 to 4 years. But again, based on our experience and the analysis that we did in our report, what we see is that within 3 or 4 years, you have market mechanisms, including investment, supply, new supplies coming to the markets, reduction in demand, and so to speak, the market force sort the imbalances out. So I wouldn't be surprised if we have higher prices, agricultural prices for the next 3 to 4 years, but I would say after that, probably they are going to go down because we're going to have both supply responses, and in the case of energy markets, we're going to have demand reduction. And that's based on our experience of what we experienced back in the 1970s, as well as what we experienced in the early 2000s, that you have a boom that kind of triggers policies and market responses that cause subsequent easing, so to speak, of energy prices. Now, the second part of the question, what kind of policies they can be followed, what we have noticed, and again, part of this is reported in the focus section of the report, is that when we experience spikes in commodity prices, you have two kinds of policies. You have the policies that are looking at a longer term perspective. For example, we can look at the 1970s when both European countries and the United States and other advanced economies, they implemented measures such as reduction in demand of the fossil fuels, increase in the efficiency of vehicle transportation, the efficiency, let's say, of home appliances, etc. And those are policies and investments that didn't help in the long term. It's what I would call the good policies. On the other hand, we have policies that try to solve the short-term problem, like what we see now, subsidies, energy subsidies, that perhaps for the short term may be required, especially, for example, if we see like policies like in Europe where the energy price or the electricity bills or the energy bills for households have gone up by a factor of 5 or even by an order of magnitude. Certainly, their governments have to act quickly and take measures that one could call them unconventional. The problem that we have seen here is that that's a warning to the policymakers, is that those policies should not stay there forever and should not become permanent. They should be transitory, and then when we are looking at policies, we should be looking on the technology side, on the new sources of the supply side, and on the reduction of demand side, rather than maintaining, let's say, subsidies. And that's an important distinction between the short term and the long term. When a short term solution is introduced, it should be very clear and communicated both from the policymakers to the people, to the consumers that are involved, that is a short term measure we're trying to fix, but in the longer term, other measures are going to be implemented. So very important message, short versus long term.
John, thank you very much for responses to all the questions that we received from the audience. Before wrapping up, very quickly, if you have any final words, please.
Again, as I said, it's we're experiencing, at least in energy markets, something that personally as an analyst, as an economist, I have not experienced. It's just I have read it in books, also the articles. We're experiencing something that is very similar to the 1970s. So that's my final thought. So, which means for a policy-making perspective, we should go back and look at longer-term solutions, as I said earlier, and making sure that policies address the short-term problem, but ensuring that in the longer term, we do not make the situation worse and we improve the situation.
Thank you very much. This morning, we had a pleasure of having John Buffett, senior economist from the Prospect Group of the World Bank, sharing the main findings of the commodity market outlook April 2022 edition, which was just released several days ago. John, thank you very much for your time.
Thank you, Koichi, for arranging that. Again, another time to thank my colleagues for helping with the report.
Great, thank you very much.
Okay.
So morning seminar will follow a Japanese tradition of observing the Golden Week holidays next week. We will be back on the Wednesday, May 11th, featuring Leola Clapper, Director of the World Development Report 2022. This will be held as a special 90 minutes edition, co-organized with JICA Ogata Sadako Research Institute for Peace and Development. Please note that registration for this seminar is required to obtain the Zoom link, not going to be broadcasted through the YouTube in a live manner, though later we'll post the recording on our YouTube channel. So please check our website for details. This will start at 9 a.m., not 8 a.m., 9 a.m. on Wednesday, May 11 in Japan Standard Time. With that, stay safe, stay healthy. See you on May 11th. Thank you very much.